Alright, good morning. This is going to be a short tutorial that's going to cover property and financial claims. Who owns the property? Now, three purposes to this video. Purpose number one, I want to review the accounting equation. Purpose number two, I want to review that term equity. And purpose number three, to get us ready for what we're going to start to talk about later in the week, and that's business transactions. So, accounting equation, equity, business transactions. Let's get going. Now, for the examples I use in this video, I want you to visualize Buffalo Wild Wings. Okay, I'm pretty positive most of us in this class have probably been to B-dubs, and if you look at this map here, they're everywhere. B-dubs are everywhere throughout the country. And if B-dubs goes out and purchases a new TV, they're going to have three options for how they pay for that TV. And that's what we're going to talk about in this video, are those three options they have to put one of those neat little stylish flat screen TVs they have up in the restaurant. Okay, so as I go through these examples, I want you to picture a Buffalo Wild Wings restaurant and the flat screen TVs that they have all around their restaurant. Let's go ahead and get started. Okay, now review accounting equation. We know that acronym ALO. A for assets, L for liabilities, OE for owner's equity. The total of your left side must always equal the total on your right side. The whole purpose of the left side, it just tracks the stuff businesses own. The whole purpose of the right side, it tracks who owns that stuff. Okay? So, assets, which is property, and there's two potential people that can own that property. Okay? There's two people that might have a legal right or a financial claim to that property. And it's going to be the creditor, like banks, or the owners of the business. Okay, now together, those two claims, creditors and owners, is what that term equity means. Equity just means who has the legal right, who has the financial claim to property. Again, let me say it one more time. Equity just means who has the financial claim to the property. Well, it's either going to be creditors like banks or the owner. Okay, so accounting equation. Now, when B-dubs goes out and they buy a new TV, generally speaking, they have three options for how they want to purchase that TV. Option number one, owner's going to go out and he's going to say, you know what, we're doing really well, we got a ton of cash in the bank, let's go ahead and use the business's money to purchase this piece of property, in this case the flat screen TV. So in this example, the owner went out, he used the business's funds to purchase 100% of the TV. So does the left side equal the right side? Well, yeah, I have $1,400 on the left side and I have $1,400 on the right side. Whose $1,400 is it? It's the owners, because they use the business's money. So this is example number one, business going out and using their own internal funds to purchase properties. Example number two is going to be the complete opposite. Okay? Now, in this example, for some reason, the business chose, you know what, we don't want to use our cash. Maybe they didn't have enough. Maybe the interest rates to borrow the money were extremely low and it was advantageous for them to keep their own money and leverage the use of interest rates by using somebody else's money. Whatever the case might be, here they chose to purchase the property on credit. So in this case, the owner has a zero legal claim to that property because he doesn't own it. He didn't pay for it. The owner has to pay the creditor back, which is going to be a bank. Okay? Now that bank, if B-dubs stops paying that bank back for that TV, that bank can take over legal right to that TV because they own it. They're the ones that paid for it. Okay, so in this case, B-dubs chose to borrow $1,400 from a bank to purchase the asset, the TV, and now they have to go back and pay the bank back. If they don't, then the bank's going to take over the legal right. Okay, again, a little trick in a cheat sheet is liabilities, again, are listed first on the right side of the equation. Why? Because if a business fails to pay back the money they owe creditors, then liabilities get first claims to the assets. Owners get second claim. That's why liabilities is listed first, because they get first claims to the assets should a business stop paying back the debt they owe. Now, the third option, which is the most common option, is going to be a combination of the two. The owner is going to put in a little bit of the business money, and the creditor is going to put in a little bit of their money to purchase the asset. Okay, so in this example, let's just say Buffalo Wild Wings goes out, they buy the $1,400 TV. However, they chose to only use $500 of their own money, and they borrowed the remainder. Well, in order for the accounting equation to balance, if I borrowed $500, or if I contributed $500, that means I would have had to borrow $900. Okay, does my left side equal my right side? Sure. $1,400 equals the total that the creditors put in, which is $900, and the total that I, as the owner of B-dubs, put in, $500. Okay, so now we both share in that legal right. B-dubs has a higher legal right because they contributed more, but eventually as I pay that back, my claim to that piece of property is going to go up, and B-dubs' claim to that property is going to go down. So those are the three options we have. Pay for it 100% using business money, pay for it by borrowing 100% of the money, or a combination of the two. Okay? So again, accounting equation, ALLO, equity. There's two people that can have equity in a piece of property, creditors or the owners. Now, before you go further, timeout, I want you to complete the activities posted on our blog. There's a couple of them up there. Just going to review some of the things we just talked about in this video. If you have any questions, let me know right away. Get after it. Good luck.